This is Matthew Cratter from Trader University, and today I want to talk about what makes markets melt up. If you're interested in learning trading strategies that work in both bull and bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So I'm going to talk about a famous episode here that happened to the Shanghai Composite Index, really from the summer of 2014, right about here, to the summer of 2015. Now, this is where stocks peaked in that summer. You can see from this little dotted line right here that we're still trading below that level. This was an incredible run up over about 12 months, and it's something that not a lot of people know about what really happened, but I think it's very instructive because it allows us to know what is possibly going to happen with other future markets. So this is the Shanghai Composite Index, also known as the SSE Composite Index, and basically an index is just a basket of stocks. So we have the S&P 500, we have the Nasdaq 100, which is the QQQs, and it's a convenient way for people, especially index investors, to invest. So the Shanghai Composite Index was something that a lot of people wanted to invest in the mid-teens. This whole story of China as a growth story. So there was a flow of institutional money into China at that point. I'm not sure the exact reason, but what the effect that this had was it became sort of a self-fulfilling prophecy. So what happened is the money started to flow in, the index started to perform really well, and the better the index performed, the more capital was allocated to it. So you got this kind of mini bubble and crash. But this one is very interesting simply because a lot of these stocks had a price limit. So if I remember this correctly, every stock in the index could move was either up 10% or down 10% a day. So when you had all this huge institutional capital flowing in, stocks would go, the vast majority of the stocks in the index for large periods of time from summer of 2014 to summer of 2015 would go limit up 10% day after day after day. But the weird thing is if you looked at the data, and I had a friend who was very much into investing in China, a lot of these stocks were not trading any volume. A lot of them would just trade up 10% with zero volume, which was very, very strange. So how did this happen? Well, I can't remember the details, but institutional investors, I believe they weren't able to buy the A shares on the Shanghai index. Either that or they didn't want to invest directly. Maybe they didn't want to buy the B shares, or they didn't want to invest directly in China because it'd be more difficult to pull the money out because of various capital flows and various rules. But either way, they didn't want to invest directly in China, but they wanted exposure to the Chinese stock market, to this major index, as well as to the Chinese economy. So instead, what they did, and a lot of macro funds, global macro funds, like to trade using futures because it's very well understood and they're very easy to price, especially for your prime broker and your custody solution. So these hedge funds would buy the futures on the Shanghai Composite. They'd buy futures on this index through a futures exchange that was based in Singapore. Now, Singapore is much more sort of Western leaning and friendly to outside investors, and that's how it sort of made a name for itself and become a very wealthy small country. So what would happen is you had these big institutional investors, mostly American and European money, that flooded into these futures, and the traders who sold them the futures, basically the people on the other side of these futures transactions, would then, I don't know if these were like market makers or people in the pit, or whether it was all electronic at this point, but basically they would need anyone who was short these futures, or a lot of people would actually want to hedge the underlying position, which makes sense. You don't want to have a totally exposed, naked short. So the way they would hedge their positions is by buying a basket of stocks in the Shanghai Composite. So they would try to buy all these stocks, but the strange thing was that a lot of even the large stocks in the Shanghai Composite that had a large market cap weighting in the index had very small floats, which means there weren't a lot of shares available to actually trade. And so what would happen is the whole index would reprice. A lot of the stocks would actually show no transactions or zero trading volume, as we said, where there weren't enough sellers who were even willing to sell at that price. And so there were people frantically trying to hedge their short futures position. There were no sellers the transaction couldn't take place. Maybe there'd be a seller at 20% up, but not at 10% up. And so what would happen is, as often happens in futures exchanges, if they go lock limit, trading completely stops. And so you had a very strange situation where the futures began to drive the actual stock market. This is a case of the tail wagging the dog. And it became sort of a self-fulfilling loop, as I said, until whatever happened, it just got too far. It basically went from about 1,800 up to close to above 5,000, so very similar to what the Nasdaq did back in the late 90s. And then everything sort of went in reverse, and stocks started going down, limit down 10% every single day. So what are we to learn from this? Well, if you have a situation where you have a very low float market, and I learned my lesson here in Tesla. Tesla had a very low float market. The shorts were a huge percentage of it, especially as a percentage of the float. You had this explosive move up. Something similar happened in the Shanghai Composite. Something similar happened in the late 90s as well with the Nasdaq Composite and the QQQs as well, where you had all these tech companies like Microsoft and Amazon, etc., that were being included in indices and becoming a large percentage of these various indices like the Nasdaq Composite and the Nasdaq 100. But the stocks had very low float relative to their market cap. So the index buyers in the Nasdaq, very similar to these, what we've been talking about that happened in the Chinese stock market, these index buyers wanted to buy big chunks of Microsoft, for example, but the float was still very low. Microsoft, I guess it had IPO'd maybe 10, 12 years before. Amazon, obviously a much more recent IPO, but the shares were simply not available. And that's why we got just this tremendous run up in the late 90s. This is one of the reasons, one of the things that contributed to the mania of the Nasdaq bubble. After this happened, some of the U.S. index designers, I know the S&P sometime in the early 2000s, I want to say 2004, moved from a market cap weighting index to a market cap weighted index that was somehow float adjusted, so you couldn't get these giant short squeezes again. But what we're seeing with all the index investing, all the passive investing, or the passive indexers, I've talked about this in previous videos, who just come in and buy the S&P 500 or the QQQs, the Nasdaq 100, every 2 weeks with the proceeds from your 401k or your company retirement plan, is you have this very unnatural dynamic that's very similar to what happened in Shanghai when the money was flowing in. And this is one of the reasons I think we could see a gigantic melt up in the stock market combined with the Federal Reserve's money printing, is simply once indexers become a certain percentage of the market, they're already 40, 45%, depending how you weight it based on money under management, assets under management, or as a percentage of market cap. They're getting very, very high. And you could have a similar situation where there's just this very large incremental or marginal demand for stocks that's unable to be met by the market. This is the idea that we've been talking about that Mike Green has been promulgating. So definitely check out his writings if you want to learn more about that. The other real situation that I see unfolding is Bitcoin. Bitcoin still has a very, very small float because there's so many hodlers who buy Bitcoin and lock it up on their hardware wallets and refuse to change it. You can look up hodl waves. We've looked at this in previous videos, just showing how more and more Bitcoin is being captured and taken off the market. At the same time, you have this new demand entering for the market. And I think we're going to see something very similar to what happened to the Shanghai Composite. Institutional investors have decided to make Bitcoin their own in the next 12 to 18 months. We see a lot of favorable regulatory action, especially in the US. PayPal coming into the space, obviously Venmo, Square's already in the space. And as a result, you have a very similar situation to the Nasdaq in the late 90s or the Shanghai Composite in the 2014-2015 time period. And as such, I think we could see another gigantic bubble. Whether it crashes is another matter. Bitcoin really should be priced at $100,000 or above using these sort of fundamental valuation models that we've talked about, like stock to flow. But either way, this is a really easy way to get to 100,000. We can see that the Shanghai Composite, it went up about 500%, I think, over 1 year. Nasdaq went up, I want to say 400% over 5 years, really from 95 to 2000. Bitcoin does this in its own way, it will go up much, much more. It'll go up probably at least 10x this cycle and maybe a lot more. I'm eventually expecting Bitcoin to hit 1 million. And once you understand how these dynamics work, where you have institutional flows or any sort of adoption flows and a small float, a very small supply, price has to adjust. In the case of Bitcoin, I don't think we see sort of a permanent crash as we've seen in the Shanghai Composite. But I think this is another reason to be extremely bullish on Bitcoin over the next 12 to 18 months in particular. If you found this video helpful, be sure to hit the subscribe button, which you'll find right below the video. Hit the notification bell if you want to be notified when I publish my next video. And be sure to let me know your questions and comments in the comment section below, especially if you have some ideas what I should make my next video about. Always appreciate your suggestions. Thanks a lot for listening, and I'll see you in the next video.